Once you know what source of finance is right for you, you're then now ready to actually get yourself, prepared and what we call in the industry investment ready. Now, there's a big problem when you pitch people when you're not investment ready, because investment ready is the process of really getting all your cards and your business in order. There's lots of things one needs to do before you actually go out and pitch. So one of the first things is looking at, I think we're doing tax structures. So if you're going to be crowd investing or you're going to be pitching to angel investors, there's a new scheme called Seed Enterprise Investment Scheme, which was launched this year.
We are living through a time when it is particularly difficult to raise money for a young business. Banks are not lending, not that it was ever easy to get them to lend to young businesses, and other investors can be difficult to find. In response to this, the government has introduced a new tax scheme to lower the risk of investing money in a young small business. The scheme is called the Seed Enterprise Investment Scheme, or SEIS. If the trade carried on by your company is less than 2 years old, with fewer than 25 employees, and no more than £200,000 in gross assets, then your company could be eligible to receive funds through SEIS. The opportunity to lower the risk and increase the returns for your investors can help you raise money by making you a more attractive investment. SEIS is similar to the more widely known Enterprise Investment Scheme and, in fact, is modeled on it, but it differs in a variety of significant ways. First, the investor gets income tax relief of up to 50% of the amount invested, regardless of the investor's marginal tax rate. Second, investors avoid paying capital gains tax on any assets sold during the tax year, ending 5th April 2013, as long as they reinvest the gain in an SEIS-eligible startup in the same year. Like the Enterprise Investment Scheme, the investment also avoids capital gains tax if the company is sold for a profit after 3 years or more. On the other hand, if the company should go bust, the investor may also be able to claim loss relief at their income tax rate on the investment which has not already received income tax relief. Let's work through an example. On an SEIS investment of £100,000, the maximum permitted each tax year, the investor would receive £50,000 as a reduction in their income tax liability. They could exempt £100,000 of capital gains by reinvesting in SEIS, saving £28,000 of CGT. And finally, they could offset £50,000 of losses if the investment completely failed against their income tax liability, potentially saving a 45% rate taxpayer £22,500. This would give total tax relief of £100,500 on an investment of £100,000. In short, if the investment goes bad, they are potentially protected to 100.5% of their investment. If the company succeeds, you amplify the value of their investment tremendously. Let's see what happens. If they invest £100,000 and take advantage of the full income tax and capital gains tax relief, they immediately save £78,000. Let's assume for the purposes of discussion that you sell the company 3 years later for 2 times the value of their investment. That's a gross return of £200,000. In the normal course of affairs, they would pay 28% capital gains tax on the gain of £100,000, equaling £28,000 of tax, netting them £172,000. Thus, in the absence of SEIS, they would be investing £100,000 for a return of £172,000. Under SEIS, though, after income tax relief of £50,000 and the capital gains tax exemption of £28,000, they have effectively invested only £22,000 for a return of £200,000. That's a 72% profit versus an astonishing 809% profit. There are restrictions on the type of companies that are SEIS eligible. The company must be undertaking or preparing to undertake a new qualifying trade, and not all trades qualify. And HMRC will run checks to make sure that a business hasn't just been set up merely to access the relief. The company can only receive £150,000 under this program, and the maximum shareholding of an SEIS shareholder is 30%. In conclusion, whether you are a young company looking for early capital or someone with a small amount of money that you would like to put to work, SEIS is undoubtedly one of the most interesting opportunities that has ever arisen.
Can I just put this in context? If you find the right investor, they can invest 100 grand in you, and if it all goes wrong, they get their 100 grand back. And if it all goes right, they get their investment was only really 22 grand for 100 grand's worth of shares. So if you go out and pitch people and show them that video, investing as you is a complete no-brainer. What's interesting, any property investor that you can find right now that's about to pay a capital gains, if they invest in you, they cannot pay that capital gains. So if you know any property investors that are about to pay a tax bill, they can put that money to you instead, rather than giving it to the government, okay? I'm not going to do all the immense amount of questions that come up when discussing tax, because I'm not a tax advisor, but just have it be known that it's out there, okay? Now, the important part is that we painfully had to figure out by speaking with HMRC in this new scheme, exactly how one would do this. And if you don't get the order right, then you don't qualify. So here's 3 tips for you if you're going to be doing this. The first thing is that you need to apply for what's called advanced assurance, and you need to do that now if you want to do this. Advanced assurance is basically a piece of paper that you can hand to investors and say, we qualify for this scheme, here's the video on how it works. That's all I do. Don't get involved in anything else apart from, we qualify for this, here's the video on how it works, okay? You don't want to get involved in all the tax advice and the complications and stuff like that. But the second bit of advice is, if you get the order wrong, you don't qualify. For example, stupid things like if you buy a company off the shelf rather than creating it yourself, you don't qualify. If you give somebody shares in a company 1 hour before they invest, you don't qualify. So there's all these little rules that you have to do and you have to adhere to. And the third thing is you've got to educate people on it, because no one knows about it. It's the best kept secret in the world. So if you just become an educator for this, it's going to be a lot easier to raise finance at the moment. And I can say that firsthand because we did it. Okay? So given all these challenges that you've got to educate people, that you've got to get it in the right order, and you've got to apply for advanced assurance, what we did at Bank to the Future is we created a process where you don't have to think about any of that. If you use our platform, we'll make sure everything's done in the right order. You won't have to worry about that because we'll do everything in the right order to make sure that it qualifies. So I'll give you an example. Let's say James is pitching for finance. I'll walk through exactly how the compliant way of doing it so you don't screw it up. So let's say James found BFG company. He found it 1 year ago, and it's an SEIS qualifying trade. What we got is a complete guide to the trade, so we can send you this complete guide so that you can just check it off, check the boxes, and see if you qualify. So he's got the qualifying things, he's less than 25 employers, and he's looking for 400 grand. Now, the maximum you can raise under SEIS is 150 grand. But the rest of it is subject to another tax scheme called EIS. And again, I don't want to go through the complications, I just want to let you know that this exists at the moment. So all you need to do, if you're James, is the first thing is you need to apply for advanced assurance. You just need to check whether you qualify. We'll send you a guide. You check whether you qualify, you apply to HMRC, and HMRC actually is surprisingly helpful at this. We'll give you the telephone number, the contacts that you need to speak to a human on the phone that can tell you in English whether you qualify. If you apply to pitch on Bank to the Future, what happens is you'll answer 10 questions. and we'll give you the complete guides for what you need to follow. You don't put any brain work into this. We've done the hard work, so you don't have to. Then what you do is you go out there and you tell some people that work in the city, that are lawyers, that are accountants, that are investment bankers, or someone that you know, that are a property investor or something like that, and you tell them about your scheme. Now, let's say that Greg invests 100K and you take them to your pitch, they hit the invest button, they pledge 100K to your pitch, and that Sarah pledges 50K, and then that's followed by Raj, who invests 250. So we'll make sure the money's held in an SEIS compliant account, which we've set up and done all the hard work for you, so that it's all in the right order, which means you haven't violated the rules. If you took that money, you violated the rules. Then what you need to do is you need to simply speak to your fellow board members, which might be just you, and have this company resolution and add them to the shareholder. And what we'll do is we'll give you the templates for exactly what to do. We'll give you the letter that you need to do. We'll give you the spreadsheet of how to do this. And you need to do several things. Firstly, you need to issue some new shares. If you sold your shares, you don't qualify. So we'll make sure you're not doing the wrong stuff here, okay? We've taken all the hard bit out. Also, you have to put your investors through anti-money laundering if you want to be compliant. Guess what? We'll do all the anti-money laundering for you. We've integrated with Equifax. We've got all the processes to make sure that it's all done in a compliant way. Once you've been through that process, we'd give you 150K, even though you raised 400. You update your members register, and then we'll issue the share certificates as part of our success fee if you raise finance for us. So we'll do all that hard work for you as well. And we work with an FSA-approved corporate financier that will make sure all the share certificates are issued in the correct way with the correct procedures, and we'll do all that for you. Then what you do is you fill out this form called a SEIS compliance statement, but you have to do that at this point in the stage. Once you've spent the correct amount of money to qualify for the next section of tax relief, you let us know, and then we'll take the money and give the rest to you so that you can then apply for the next tax relief, which is available under EIS. Now that sounds complicated, but all you do is follow our steps. We've made it paint by numbers so that you don't have to think about any of this stuff. If you issue the wrong type of shares, you don't qualify. So we'll make sure that you're doing the right type of shares. Now there's a beautiful part about this that I'm not sure if HMRC intended to do this, but you might have an investor that says, well, I'd like preferential treatment if the company goes bust, or I'd like, if you ever issue any new shares in the future, that it doesn't get diluted. If you give them any of those preferences, you can then say to them, well, I could do that. However, you won't qualify for SEIS and you won't get your tax breaks. So it's put a lot of power back to you in the negotiation. Once you got that money, you fill out your EIS compliance statement. Greg claims back from HMRC 50K check in the bank after investing in you. Sarah gets 25K, and Raj will claim back 75K. They get the money just straight from HMRC off their tax exemption. If Greg then sells a property, he'll get a load more money back because from that as well. If the company goes really well, then they pay no capital gains tax. Normally, if a company goes really well, you pay a massive chunk to HMRC. If it goes really well, they pay. If it goes bust, they get their money back, if they're the right type of investor. So what you've got to do is just find the right type of investor. What you're looking for is people that are essentially high-rate taxpayers. I'm sure you all know some that are around you right now. Bankers, lawyers, accountants, just stalk the city. Yeah. It's a great way of redistributing money that all those bankers got paid back into something productive. Yeah? And I think it's going to work, and it's going to work a treat. It's the best thing that the government's ever done. It's the most generous thing in the world, and it's a massive opportunity for all of us as business people to take advantage of this. If you go out and raise finance under a crowd investment or under angel, and you don't find out whether you qualify for this, you should be shot, because you're making yourself 78% more expensive than your competitor who's seeking finance with you.